Thanks for everyone for joining us here. My name is Martin Sorge on the BALLE team, and we really appreciate that you all here. So welcome to this crash course in community capital webinar brought to you by the Business Alliance for Local Living Economies. My name is Martin Sorge, and I am the program manager here at BALLE. We have over 100 and some localist leaders from across North America registered for today's webinar, so we're really delighted to have you all with us. Thank you. Since a lot of you are new to BALLE, I'd like to just spend a minute to tell you a little bit more about our organization. BALLE is the fastest growing business alliance of values-aligned entrepreneurs, business networks, and local economy funders across North America. We are leveraging the collective voice of this movement to drive new investment, spread the best solutions, and harness the power of local, independently owned businesses to transform the communities where we all work and live. BALLE believes that certain principles matter to achieve sustainable, resilient, happy communities and thriving local economies. We believe that ownership matters, place matters, opportunity matters, nature matters, that we must measure what matters, and that relationships matter most. And don't forget to like us on Facebook and follow us on Twitter, where we will be live tweeting this webinar. And now for a bit more about BALLE's Community Capital webinars. These webinars feature case studies with community capital innovators like we have on the line with us today. And these are pioneers who have developed and piloted working models for connecting local people's investments to local businesses and farms, using local resources to meet local needs. We suggest that you treat these calls as an opportunity to bring together a group of business owners, social entrepreneurs, and local government officials, policymakers, or network leaders in your community who are interested in the topic at hand. After listening to the webinar, you might spend an hour discussing with your group the applicability or relevance of these models in your community and come up with the next steps for action. We encourage listening parties, and we hope you use our webinars as a chance to gather folks together. Now I'd like to introduce our speakers today. Today's webinar is a special crash course in community capital, where you'll learn about community capital from sources of capital to innovative tools, from local investing clubs to lending circles. You'll get a 30,000-foot view of the local investing landscape and learn about ways to put it into action in your region. This webinar is based on BALLE's new Community Capital Toolkit, featuring a guide to community capital, which is a 20-page resource to help you get your community investing locally. By attending this webinar, you'll receive special advanced access to this guide and to this toolkit, which will be released to the public in the next week. And now for a little bit more about our speakers. Merrian Borgeson, who will be leading this webinar, is the co-founder and principal of Tule Partners and founding director of the Sustainable Business Network of Philadelphia. She's a former BALLE board chair and currently a BALLE advisor in the area of community capital. She's a researcher at the Lawrence Berkeley National Laboratory focused on the financing and development of energy efficiency and renewable energy. Marion currently serves as a trustee for the Goggio Family Foundation, an advisor to the Schumacher Center for New Economics, and as a board chair for Jacaranda Health. Also joining us today are 5 community capital innovators who will present short case studies on each of their local investing initiatives. Joining us for those case studies are Mickki Langston from the Mile High Business Alliance in Denver, and she's a 2013 BALLE Local Economy Fellow. Also joining us is Sarita Schaffer of Viva Farms in Washington State, and she's also a 2013 BALLE Local Economy Fellow. Daniel Lau of Mission Asset Fund is with us, as is Teri Lovelace of Virginia Community Capital and Dan Rosenberg of Real Pickles. I want to give a big thank you to all of our speakers, to Merrian, Mickki, Sarita, Daniel, Teri, and Dan for presenting at today's webinar. And with that, we'll pass it off to Merrian.
Great. Thanks, Martin. And thanks for everyone who's joined us here today. We have a large group on the line, and we're excited to give an overview that will hopefully lead to many of you going out and starting or joining new initiatives or existing initiatives in your own communities. So what we'll cover today, a lot of this is in more detail in the Community Capital Guide that Martin mentioned. So I'm going to spend my time going pretty quickly at a high level over some of those themes that are covered in the guide. And then we have the opportunity, which I think is the most important part of this call today, to hear from folks on the ground from around North America who are doing really amazing things in their own communities. So first, it seems sensible to start with the sort of question of what is community capital and why is it important? What we found through BALLE's many networks across North America is that business owners and social entrepreneurs in many places are struggling to find access to the funds that they need to launch or expand their businesses and initiatives. And at the same time, most of our financial investments are going to unfamiliar, opaque entities in faraway places, and they have impacts from which we are largely and almost entirely disconnected. And I think it's safe to say that the dominant financial system is not working for most people in many of our communities around North America and around the world. Global capital markets tend to drain, not build up, the health of our local communities. And the current system is really based on perpetual growth, the concentration of wealth and power, and externalizing the costs of doing business. And what we've found through real examples around the world is that it doesn't have to be this way, that there are many exciting and interesting alternatives that are being developed and that actually have long histories in some cases. It's really possible to use regional resources, regional wealth, to meet our needs locally. And that's really what community capital is about. It means reconnecting eaters with farmers, investors with entrepreneurs, and business owners with the communities and natural places on which they depend. So it's really about transparency and connection being brought back into our financial system. And this really requires reshaping the ways in which the financial capital flows through our local economies. We can tap into the wealth we have and redirect it to community-serving businesses and organizations that create real long-term value. And importantly, these organizations then also recirculate this wealth within the community multiple times. So you're really benefiting the whole community and building up what we have in a local place in a way that we can connect to, understand, and really celebrate at a local level. It's also important to note that we do focus on financial capital in this guide, but we also want to recognize that there are many kinds of wealth in communities, not just money, not just financial capital. It's just one of many resources, and it's certainly the term community capital can be used to be quite a bit more broad. Just in this context and for this guide, we're really talking about financial community capital. So just want to make that clear. So community capital can take many forms. One of the challenges with community capital is there's no step-by-step roadmap to developing it in your place. It's really unique to what's needed there, what the resources are there, and what people are excited and energized to do. So there's not, if you have these 10 organizations, you're set, your community capital is taken care of, good job. It's really a creative, dynamic process, kind of understanding the range of things that you can do with capital to reclaim that wealth and keep it in a community. That's a dynamic process. That's a local process. So today we're going to talk about a lot of different examples, just a few specific examples so you can start to imagine the range of things that community capital might entail or might include. One example is a dairy farmer pre-selling her yogurt to finance an expansion of a dairy, let's say. Or an entrepreneur who gets startup capital from a lending circle of peers. Daniel's actually going to be talking about a specific example, organization that helps folks do that today. Solar Energy Worker Cooperative who's selling preferred stock to fund a bulk purchase of solar panels. I'll mention, different forms of stock briefly, but it's in more detail in the guide. And just one note on language. Preferred stock can be a pretty intimidating term for a lot of people. What I found is that many of the terms in the financial world are largely, they're simple terms once you understand what they mean, and they can intimidate folks. And we as folks who want to see thriving local economies have to kind of learn the language a little bit enough so that we can reclaim the space of finance and of getting community capital models started in our community. So the guide does go through some of that language that just gets us comfortable so that we can be leaders in that space. Another example is local citizens redirecting their investments to support a pooled fund that invests in a local food system, for example. Or a community development financial institution, also defined in the guide, that offers loans to startup entrepreneurs and to in an underserved neighborhood. Or a grass-fed cattle producers cooperative who sells equity shares to their members to fund collective processing and distribution activities. So clearly, this list of 6 examples, hugely diverse. They're not of one type of activity. There's so many creative ways that we can use capital in our communities, and that's really what we want to encourage through BALLE. In terms of the type of capital that we have available to us, there's 3 main types, and there's also a lot of gray area in between these categories. So the one that people are probably most familiar with are grants. So foundation grants is a clear example of this. But there's also many crowdfunding platforms, and most of those, the ones that are currently legal and used online, most of them are actually using gifts as opposed to an investment where you expect a return back. So that's the first type. The second type is equity. It's really a stake in the ownership. So an equity investment are really purchasing an ownership share in a business or project. And unlike debt, which I'll talk about in a moment, which must be paid back, equity investments have no repayment timeline usually. They entitle whoever has that ownership stake to a full or partial piece of that venture, and equity investors benefit over time from an increase in that business's or project's value, and which they might realize when they sell those shares or the company is sold, or simply from the range of non-financial benefits that an entity might provide. So you might want to own a business that you just feel good about what it's doing in the community. So there's a range of reasons you might own a stake in a business. The most common form of equity is common stock, where each share entitles the owner to a portion of the ownership of the company, usually a dividend payment, and also typically involves some sort of voting or decision-making authority for that entity. You could also have member equity in certain types of cooperatives where the worker members or different forms of members are owners and the organizational decision makers in a cooperative. And then the third type of financial capital that we need to start to get familiar with is debt. And all debt is really a form of a loan, and people are usually familiar with the word loan, but there's lots of forms that can take. At a basic level, debt investments mean lending money to a project or business, and unlike equity, they must be paid back, often with interest. Not always. It depends on the relationship. And typically they have a pre-specified payment schedule. The debt investor doesn't own the project, so they usually don't have a say. They usually don't have voting rights. They usually don't get dividends. And in general, debt tends to be more secure than equity in that if a project or business fails, the remaining funds or assets, if any, go back to the debt investors first before the investors or owners get money. There's often a distinction between secured and unsecured loans. Secured loans simply have an asset that backs it up, that the holder of the debt, the lender, can take that asset if the borrower is unable to repay, whereas unsecured loans don't have a similar asset attached to that debt. Bonds, also a term that we often hear, but at a basic level, these bonds actually allow investors to take a small piece of a much larger loan. So you might have heard of a municipal bond where a city might issue, a $10 million bond to fund maybe improvements to their to some infrastructure projects, and they sell those to many, many, many investors in small chunks, maybe $1,000 here and there, that allow them to finance a much larger project. And another term that it's important to know about is a credit enhancement. Credit enhancements reduce investor risk by protecting against losses. They're often in the form of something called a loan loss reserve. And again, if this language is overwhelming to folks, it's all in the guide, and you can kind of go through it more slowly. But the fundamental point about a credit enhancement, it's usually a pool of money that protects the investor and gives them the encouragement and confidence to invest in a project or a business that they might not otherwise have been willing to take the risk to invest in. And Sarita is going to talk about one example of that with a fund that's for new farmers. There's also a bunch of, as I mentioned, a bunch of examples that don't fit one single category of these three. Just as an example, preferred stock, which is often issued by cooperatives and many other entities, the shareholder receives an ownership stake, but they receive an ownership stake, but they don't actually get many of the features of ownership. So, for example, they're typically not entitled to vote on company decisions, and there's often not a fixed dividend. It essentially functions like a loan, even though it's a form of stock. So there's a bunch of different categories like that and creative ways of using these tools. And the 5 examples that we are going to go over today will help you kind of think through what the different options are. Another thing that we go through in the guide is the sources of capital. There's many, many sources of capital in a community. Individuals are one that many of our examples, in terms of getting investments from an individual, are one that many of our examples focus on, because so much of individual investments are going towards these large opaque, they might be investing in the stock market, or they have a pension fund, or there's all these investments that we are very disconnected to that can be changed on an individual level. One thing that's important to note is there is a legal distinction between investors that can afford to lose money, as defined by the law, at least in the U.S., and those that are more restricted in what they can invest in. So accredited investors are what we call folks who essentially that the government has deemed can afford to lose money, and it means they have a certain level of financial wealth. The other 99% of people, literally, are unaccredited investors, and part of some of the examples today and many of the examples in the guide talk about how can we get unaccredited investors to be able to find ways of safely and directly investing their funds into institutions, organizations, projects that they really care about in their own communities. Many other sources of capital, banks, credit unions, community development, financial institutions, all of these have different, they're different in your community. There's going to be different smaller banks, for example, investment funds, credit unions. One thing that's important to note is that we've generally found in our networks across North America that the smaller and mid-sized organizations, credit unions, banks, tend to be more likely to invest in small businesses. So, for example, in the U.S., small and mid-sized banks hold just about 22% of U.S. bank assets, but they make over 50% of the small business loans. And that's partially because they're more rooted in place, they're more interested in developing relationships with local entities, and therefore have more confidence to invest in those entities. What you're going to want to do is look through the guide, kind of review the sources of capital that we go through there, and then look at your community and just map out what financial resources do you have, what's missing, and what's needed. And it's most important to ask those you want to serve what they think is missing. What types of capital, what types of support are they looking for that just is not there in your community that you could help them with, that you can partner with another entity to expand access to capital for those folks. This is a huge list of some of the tools and models that we review in the guide. I'm not going to go through these here one by one, but they are in the guide, and we'll talk about many of them, several of them on the call today. I also just want to touch on crowdfunding because so many folks know that that's a hot topic right now, exciting topic. And it actually has many different forms that it comes in. It's not one thing. There's generally 3 different types of crowdfunding that we see. One is raising gift money, as I mentioned in the beginning, the donations that have online platforms like Kickstarter, Indiegogo. Usually you get either nothing in return in terms of financial capital, but a lot of goodwill and excitement about what you're investing in as a donor, or you get some sort of small token of appreciation. And by having it just be gift money, there's very few legal restrictions that arise from that type of investment. There's also a second kind that involves pre-sales, collecting payments in advance for goods and services. So Credibles is an example of this, where they allow a lot of food entrepreneurs to sell their yogurt or their cheese or whatever they're offering in advance to fund, they might fund the seeds that they have to buy for that year, or they might want to fund an expansion of part of their operations, and they're able to pre-sell their goods and then give those goods later. That's a second example. And the third example, that's probably the trickiest, is providing financial return. So really an investment into many people investing into a business or a project. This is the trickiest one just because there's a lot of laws that are associated with regulating investments. And the book I mentioned on the screen there, Raising Dough, has a bunch of examples of that, and that's one resource. We go over a number in the guide, and there's a few other resources that we'll mention a bit later as well. One example of a sort of crowdfunding way of investing in a business or project is a direct public offering. And that's becoming a much more interesting and widely used form of funding. Real Pickles, Dan from Real Pickles, will be talking about his specific example today. But a direct public offering allows an entity to sell debt or equity. They really get to structure the deal themselves and sell it directly to the public. And they can also advertise, which means that they're able to get a broader range of investors to support their entity. There are a number of securities registration that can be required, and that can be expensive and time-consuming. To reduce the cost of all those legal registrations, many entities that are issuing direct public offerings use exemptions in the security registration requirements that may restrict the total amount of money they raise or the number of investors or the location of investors. So, for example, Farm Fresh to You, a community-supported agricultural farm in California, it limits their issuance to only California residents. So there's a bunch of examples. Cutting Edge Capital, which is an organization that offers legal support for issuing DPOs, is a good organization to check out. And they have Cutting Edge Exchange, which is an online platform where you can check out current offerings where you can actually purchase shares in these organizations, including places like Farm Fresh to You, People's Community Market, and a number of other ones. So with that, I actually want to turn it over now to the real examples that you guys are all here to hear about. We're going to start with Dan Rosenberg from Real Pickles, who will tell us about his direct public offering. Dan?
Great. Thank you, Merrian. Thanks for having me. Excited to be part of this. So I'm from Real Pickles. We're based in Greenfield, Massachusetts, in Western Mass. I founded the business in 2001. We make raw, naturally fermented pickles, cucumber pickles, sauerkrauts, kimchi, from locally and regionally grown certified organic vegetables. And the business was run as a proprietorship with myself and my wife, Addie Rose Holland, for the first decade plus. We built up the business over time. It's a business with a very strong social mission. We're in business to try to bring a traditional healthy food, fermented pickles, back into the American diet, and also trying to support the development of a new kind of food system, particularly regional in scale, organic, run by small businesses rather than big corporations. Our central commitment has always been to buy our ingredients locally and regionally within the Northeast U.S., and then only sell our products within the region, so we won't ship across country. And it's really to promote this idea of a local and regional scale organic food system. So after about a decade or so in business, building up the business, we finally reached a place where we felt like we'd turned Real Pickles into a successful business. We were buying 300,000 pounds of vegetables, certified organic vegetables from local and regional farms annually, operating out of our own 100% solar-powered pickling facility, and making a pretty good income as a business. And so my wife and I, the question arose for us, really, what's the best way that we can ensure that Real Pickles would continue far into the future to succeed financially and also, really importantly, maintain its strong social mission. And we spent a while considering the options, talking with our staff, and in the end we decided we wanted to convert the business into a worker-owned cooperative. And first and foremost, the reason was it felt like a really the best opportunity to preserve the social mission. You can inscribe the social mission into governing documents of the co-op and make them really hard to change. And we are also excited to bring our excellent staff into the fold, into the ownership of the business. So there were a lot of details to work out, but a key detail, and the one relevant here, was how are we going to finance the transition? Essentially, we were going to be forming a worker cooperative entity owned by the staff in the business, including Addie and myself, that were choosing to become worker owners. And that worker-owned cooperative was going to needed to be able to purchase the business from Addie and I, and also have the operating capital needed to run the business. So the question was, how were we going to raise that money? So we evaluated a variety of financing options, and in the end we settled on selling non-voting preferred stock through a direct public offering, and to sell that stock to outside supporters. So we hired Jenny Casson at Cutting Edge Capital, who Merrian mentioned, in Oakland, California. They're really the experts in this kind of thing, and they helped us through the whole process. The terms of the investment that we set up it was a $2,500 minimum investment. We needed to raise $500,000. So a $2,500 minimum investment. We offered a 4% target dividend, so we would choose on an annual basis what we could pay. It wouldn't be guaranteed, but our target would be 4%. A 5-year holding period. We felt like we could recoup that, generate the profits to redeem our investors' shares over that kind of a time frame, but probably not sooner. and we would be redeeming the shares when we did get to that point for the original issue price. So the price wouldn't change. So there wouldn't be a pressure to grow the business. A real key commitment of ours is to be a small business and stay that way. So that would help keep us from feeling pressure to grow more than we felt was responsible. So we could have sold our stock privately, which would have been cheaper and less of a hassle, but we ended up choosing the direct public offering route to sell this stock, which Merrian mentioned some of the reasons why you might do that is it allowed us to advertise, and it also meant that we could take investments from an unlimited number of investors, which meant that we could have set up a lower minimum investment and still be able to reach our goal. So we were able to make it more of a community campaign, more widely accessible to our community. So we filed with the state regulators, and we had about a 5-month back and forth responding to comments and questions from the regulators, and then finally got the go-ahead to do our campaign. And this was in February of last year, of 2013, that we launched the campaign, got the go-ahead from the regulators. We crafted a really careful marketing campaign using email and Facebook, reaching out to individual supporters, putting out press releases, setting up investor briefings and other kinds of public events. And it was incredibly successful. We felt really happy with the results. We raised the $500,000 we needed in just about 2 months, a little less than 2 months. And this came from 77 investors in Massachusetts and Vermont, the 2 states we filed in. And it's a mix of individuals and businesses, some of the food co-ops that sell our products, other customers, farm suppliers of ours, and so forth. And so we raised those funds, and then on May 9th of last year, we converted to a worker-owned cooperative using those funds. So we're really, really happy with the results.
Thanks so much, Dan. Do you have a sense of what motivated your investors? Was it simply to show support for you guys, the financial term? What's your sense of that based on who signed up and?
Mm-hmm. Yeah, I mean, I think it was a range of reasons, but certainly we got the sense that there's a lot of interest in local investing and people being able to invest their money someplace other than Wall Street and in a business that they believed in. And so we were able to, there are not a lot of businesses have gone through these, jumped through these kind of hurdles to be able to offer a direct investment like this. There aren't a lot of opportunities, so that was key. And, we'd been in business for 12 years and had developed a lot of community recognition, and people, I think, wanted to support us, and they recognized this as a socially beneficial move for us to become a worker cooperative. So it felt like there was even if the financial return on the investment was modest by Wall Street standards, there still was a lot of social return to be had. So. Yeah.
Great. Thanks so much. We're going to move on to our next example, and I just want to remind folks that you can ask questions in meeting chat on the left-hand side of your screen. We'll respond to some of those in writing, and some I will moderate as well directly to the speakers. So let's go next to Sarita, who will talk about the Farmer Reserve Fund.
Good morning, everyone, and greetings from an unseasonably sunny and jubilant Seattle, Washington. The city is still recovering from our 700,000 person Super Bowl victory march yesterday. So it's a good day in Seattle, and I'm really excited to be with everyone today. So as Merrian said, my name is Sarita Schaffer, and I'm the founder of Viva Farms. Viva Farms is a bilingual organic farm business incubator, and we're located in the very picturesque Skagit Valley, which is located about 60 miles north of Seattle, Washington. Our work I can sum up in about 6 words, which makes it sound deceptively simple. We help new farmers get started. And the vast majority of the startup farmers that we work with are Latino farm workers. These are folks who have worked on field crews for sometimes as many as 20 years, which when I say that, it makes them sound older than they are. But many of them start working alongside their parents when they're children. So they have that kind of experience by the time they reach the age of 30. And as the phrase farm incubator implies, we provide to farm businesses what a more typical business incubator or business accelerator provides to fledgling businesses in other sectors. So if you think of it this way, instead of offering resources like office space and conference rooms, we provide affordable access to farmland. We provide access to equipment like tractors and implements and cold storage. We provide technical assistance both on production and business development. We provide access to markets for the farmers' products. And last but not least, which is what brings us here today, we provide access to startup capital, which is really the special elixir, I think, that fuels pretty much all new enterprises and not just farms. So we have a couple of different ways that we help farmers access capital, but the one that I'm going to talk about today, as Mary mentioned, is our microloan program, which is called the Farmer Reserve Fund, which we launched in partnership with Slow Money Northwest and North Coast Credit Union. And I thought I'd cover kind of three aspects of the Farmer Reserve Fund. I'll start with, I would say, an extremely abbreviated version of the loan fund creation story. Then I'll talk about how it works, and I'll conclude with what I would consider our kind of key lessons learned. So does that sound good to everyone? So you guys are all muted. Okay. So we knew from the outset that startup capital was going to be a really critical component of Viva Farms. Because we knew that lack of financial resources is the primary obstacle that prevents Latino farm workers and most young farmers from starting their own farms. The minimal startup cost of farming in the Seattle and Puget Sound region is somewhere around $30,000, and that's on the very lowest end. And that basically gets you a land lease, a used tractor, maybe an unheated greenhouse that you built yourself, and some of your production inputs like seeds, transplants, etc. If you're really lucky, you might even be able to sneak in a really shoddy delivery van with that. So that's, really the bare minimum to get you into the game. And to people that are working in other industries, especially high tech, which of course dominates Seattle, $30,000 for startups sounds like peanuts. But it's not if your annual income is around $12,500, which is the average income of U.S. farm workers. So as soon as we started Viva Farms, we really started talking with some of our key allies about how we were going to overcome this obstacle, the financial obstacle. And we went first to Slow Money Northwest, which is a group of local investors who are really interested, in investing in local food and ag. And Slow Money Northwest was extremely interested in helping us develop a loan program. In fact, before we even started talking about models, Tim Crosby and a couple other folks immediately rounded up about $5,000 and said, "We're ready to go. Let's start experimenting. Who can we lend to?" And we said, whoa, hold on. Let's figure out how to do this most effectively, because we knew that we didn't want to do direct loans to the farmers, because we didn't want to be in a position. Viva Farms, like our organization, didn't want to actually disperse the loans, because we're not a banking institution, and we certainly didn't want to be in a position where we would be a sort of business coach and friend and advocate, an incubator, and also having to follow up on loan collections, which just could put us in a very compromised position. So we turned to our most obvious partner in the financial industry, which was North Coast Credit Union. They're our local credit union, and it's where Viva's accounts, our organization's accounts, are held. And they were really happy to help us. They said that our timing was perfect. The credit union had just experienced a pretty significant influx of new deposits as a result of the Move Your Money campaign. So they were actively looking for new ways to invest in the community. And of course, like being situated in a very agricultural community, local farms were something that they were especially interested in. So they said, we talked to the president, he said their main hesitation was that they didn't really know how to reach out to farms. It's not a group that they specifically do business with, and they felt that their loan officers didn't necessarily have sufficient agricultural experience to feel really confident evaluating a farm's business plan or a loan application for a farm business. So we basically struck a deal. We said, North Coast, if you administer the loans, we'll assist you with the due diligence practice and the outreach and supporting the farms that are receiving the loans. And we decided to start with farms that were already within Viva Farms' network, since we had the strongest relationships with those farmers and had, the best access to their financial data. So this is how it works. We used the $5,000 that was donated by Slow Money investors to create a reserve fund. And for those of you who aren't familiar with reserve funds, they're nothing new to the banking industry. As I understand, they're actually set up in advance of any lending. And it's really it's the size of the reserve fund that varies. And the size of it is it's based on the estimated default rate of the people who are going to be borrowing from it. So basically, the riskier the loan, the larger the reserve fund. And since we had never tried this type of loan before, either parties, we decided to be really conservative and assume a pretty high default rate of 20%. So that meant that every dollar that slow money investors deposited in the reserve fund account, North Coast would make $5 in loans that without the reserve fund they probably couldn't or wouldn't have made. So overnight we were able to turn the $5,000 that the slow money investors had rounded up into $25,000 of available loans. So that was pretty exciting. And the way the reserve fund works, as more funds are repaid, we get more data about what our true default rate is. So if it turns out that instead of a 10% default or a 20% default rate, we actually have a 10% default rate, that means that $10,000 of local investors' money just deposited in this account could be turned into $100,000 of available loans. So there's really a huge potential to scale up on the loans as the farms grow and require bigger, larger sums. So just a little bit on how it works. Farms actually apply for their small operating loans through the process that any borrower for North Coast Credit Union would go through. North Coast looks at the borrower's loan amount, they look at their credit history, their business plan, their revenue projections, et cetera. If everything looks really solid to them, the business gets a loan and nothing else is needed. In some cases, if they feel that the farm actually qualifies for any of their other lending programs or vehicle loans or anything, they don't even need to touch the Farmer Reserve Fund. But if the applicant has either insufficient or damaged credit history, which is often the case with immigrant farmers who are, supporting families back home and don't always, sometimes will get in trouble with credit cards and such, North Coast basically calls in Viva Farms to help understand and evaluate the application. So because of the relationship that we have with the farmers, Viva is able to provide a lot of additional character references, insights. Like we know the farmer's history of making payments at Viva. We lease land, we lease equipment, and other resources. So we know if this is someone that pays their bills on time, if they show up to meetings. That's kind of what their character is. We also know how they take care of their equipment, and that's a huge part in running a business is whether you take care of your assets. And we know if the farmer is, how effective they are at marketing their crop and how likely they are to bring in the amount of revenue that they've said that they're going to for the loan. So based on that information, Viva either advises North Coast to grant or withhold the loan. We also help make sure that the repayment schedule makes sense to the particular business, which can really vary depending on what kind of crops the farmer is growing. And probably most importantly, once the loan is made, Viva is there on a day-to-day basis to really support the farm and their operations and make sure that the farm is successful and is able to repay by the end of the season. So that's how it works. To date, most of the loan applications have been in the $1,000 to $5,000 range. We're definitely seeing them step up a bit as the farms grow. They're usually used for covering the purchase of plant material, used equipment, and other supplies that are needed early in the season, which is when farmers incur all of their costs but don't yet have revenue. I saw a question really quickly about the terms. There's 9% is the typical interest rate on the loans, and it's important to understand these are totally unguaranteed loans. They're not. There's no collateral in the transaction. So, yeah. And I'm going to avoid the questions until I finish my low piece just so I don't get too distracted and lose my train of thought. But before I end,
Pretty quick here. Thanks.
Okay. Right. Great. In terms of lessons learned, I would just say that there's no shame in repurposing an existing model, and I think that's what we really learned, that this reserve fund was already there. It might be more sexy and exciting to create a new vehicle, but it could be that the thing that you're looking for is right in front of you. And the second and last that I'll close with is that it really is about relationships. In BALLE, we say that relationships matter most, and I think that's definitely true, that this program couldn't have happened without our strong partnerships with Slow Money and North Coast, and definitely the very established relationships we have with the farmers. So I will leave it at that.
Thank you so much, Sarita. And again, folks, feel free to ask questions on the meeting chat, and the speakers, you should also feel free to respond in writing if you'd like as well, if other questions come in as other folks are speaking. So let's move on now to Teri Lovelace from Virginia Community Capital. Teri.
Okay, thank you very much, BALLE, for having all of us here today. Virginia Community Capital is a CDFI, as Merrian had mentioned earlier in the presentation. There are about 800 certified CDFIs in the United States, and they can take a whole bunch of different forms. They can be loan funds, they can be credit unions, they can be a bank. VCC is also a bank, or they can be venture funds. And if you are interested in finding a CDFI in your community, check the website for Opportunity Finance Network. They will have a listing of all the CDFIs throughout the United States. But overall, a CDFI's mission is to dedicate its resources to financing projects for low-wealth individuals or underserved communities. So think of small businesses where there's maybe not a lot of capital. Think of affordable housing projects, community centers, areas that will help promote the community. And VCC, we like to think of ourselves as we get capital flowing to areas that traditional capital won't flow. So maybe your traditional lenders or banks won't take the risk with a small business or with an affordable housing project. CDFIs will oftentimes be the first lender in a community that will get other capital flowing. And the three areas that they generally work in will be small businesses, the affordable housing arena, and then community facilities like health care centers, daycare centers, or those facilities in a community that add value to the community. So VCC serves the entire state of Virginia, and we are making loans, both business and real estate loans, throughout the state. We have about $102 million in assets, and we're making about $60 million a year in loans to businesses and real estate projects. What I would like to talk about are three kind of ways that a CDFI can link maybe local wealth to small businesses and real estate projects. Something that we have we've instituted is a local impact opportunity note. This is a short-term investment in VCC where investors can receive both a social return and a financial return. And these investors can say, I want my dollars to go to a specific geographic region and to help businesses and other types of affordable housing projects in that area. These investors are not having to invest directly in a business. They're doing it through an intermediary like VCC. So they're getting a below-market return, but they're also getting a social return on their investment. Another way that CDFIs and particularly VCC is working in this space is serving as an intermediary for philanthropic foundations, particularly in the area of a program-related investment. So you may have a local foundation that wants to support food businesses, but they don't have the expertise or the staff to go out and make loans to food businesses. What they can do is partner with a CDFI and have a program-related investment where the CDFI will go out and make those loans. We have underwriters on staff, so we're used to making loans, and we can evaluate the risk associated with that type of loan. So what a foundation can do is use VCC as an intermediary to help facilitate those types of loans going out into the community where a foundation may not have the expertise to directly make a loan to a small business. It also helps by diversifying the risk that the foundation will take in getting an impact in the food business without investing just in one company. And then finally, the other area that we're able to tie local wealth to local community projects is something we have as an impact deposit. Because we're a bank and we're FDIC insured, we can attract deposits, money market CDs, from socially minded depositors who want to earn market rate returns on their money, but they know that those dollars will be used for projects that are in their state or in their community. So that's been another way that a CDFI, who's also a bank, can link local capital to local needs. Something to look for when you're working with a CDFI is to see if they're, make sure that they are a certified CDFI. And you can also, most CDFIs will go through a CARS rating, which will be a third-party verification on the CDFI's social impact as well as their financial strength. So that's a way to evaluate just really how strong the CDFI that you're working with will be. So I think that covers it for me.
Yeah, thank you so much. That's a great overview. And so many of those concepts that I mentioned are demonstrated by Virginia Community Capital, so it's a really wonderful model to check out in more detail. We're now going to move on to Mission Asset Fund, and Daniel Lau will be talking about their lending circles.
Hi, good morning, everyone, and thanks to BALLE for having me and Mission Asset Fund this morning. So today I'm going to be talking about our Lending Circles program. The Mission Asset Fund is a nonprofit organization based here in San Francisco. We were founded in 2007 with really the goal of providing asset-building programs and services to low-income and immigrant communities across the U.S. And our flagship program is this Lending Circles. And what I'd like to present is that the activity itself is really it's very simple and it's very basic. It's straightforward, a group of people who come together and lend money to and from one another. So everyone in the circle is a lender and everyone in the circle is a borrower. And this activity is really rooted in cultural traditions, and so it's an activity that's taken place before there were things as banks and credit unions. And some of the names that it goes by in different countries is tandas or susus or cumbinas in Latin American, Asian, African countries all over the world. So I'm not sure if people are familiar with any of those terms, but there usually is some reference or some familiarity with people all over the world with this kind of activity. But what we've done at Mission Asset Fund to build upon this innovation and to formalize this process to bring it into the United States financial system is that we ask each participant to sign a promissory note to then formalize this lending activity, and so we can report the payments to the credit bureaus each month to help build and establish their credit. And so I found usually the easiest way to explain what we do is to go through an example and demonstrate how a lending circle works and how it operates. So let's say there's a group of 10 people. They want to form a lending circle together. And within their group, and I want to emphasize that the way we operate and manage the program is that the members of the lending circle make all of the decisions for their group and for their circle. Our role is simply to facilitate, provide the space to manage and organize this activity. So it's a group of 10 people, and together as a group, they decide that they're each going to contribute $200 into their lending circle. And so what happens is every month that $200 from each individual is collected and pulled together to form this community capital fund. And one person each month gets to access that $2,000 community loan to be able to use for whatever their financial goal or financial purpose is at that time. And so that's the first month of activity. The second month of activity is that, again, $200 is collected from each Lending Circle member, and then another individual now accesses that social community loan. And it's that $200 contribution that they make each month that we report to the credit bureaus that can help establish and build credit. I want to give some examples of how people have utilized the program and what the benefits and impacts are. So definitely we've had participants who join the program to support their small business. I think the different range, and there's different parameters and different range amounts for that monthly contribution amount, but that loan can then be used to support inventory or maybe support a new venture within their business. We have a lot of people who are wanting to start their own food businesses or food trucks, and so you can imagine that the funds can then go support their endeavors and their efforts in growing and creating their business. The program is also a great way to save for either a planned large expense or to create an emergency savings, or to also pay off debt, and again, to also build credit to further access more traditional loans as they complete and finish the program. And I want to finish off by saying that we are actually at a great place to be providing this presentation because we have a partnership model that allows us to collaborate with different nonprofits throughout the United States so that different agencies can offer the Lending Circles program through their agency and manage and operate these Lending Circles in-house through their offices. So we have a model where we can partner with you if you would like to offer this program to your constituency and to the community to work together and to be able to expand and replicate our efforts. So I know that the BALLE folks will definitely have contact information afterwards, so to hear from you all and see how we can work together.
Thanks so much, Daniel. Really appreciate it. And we're going to move now to our last presenter, Mickki Langston, BALLE Fellow, about a new innovative model that she's launched in Denver. Mickki,
thank you guys so much. It's so great to be a part of this conversation. And so what we wanted to share about is our project and crowdfunding platform called Neighborhood Catalyst. We actually launched Neighborhood Catalyst October of 2013. And I'm going to give you just a little bit of very brief background about our organization and the reason that we wanted to do it this way, what makes the platform unique, and then really what's next for us in sharing this approach with our community and hopefully other communities. And so Mile High Business Alliance is a membership-supported local business network. We have not quite, somewhere between 250 and 300 business members. And we decided to start the work of community capital in our place by creating our own Kickstarter-like crowdfunding platform that allows people to contribute individual gifts towards projects in their neighborhoods. And so that's really one of the things that makes Neighborhood Catalyst unique, is that people and projects are organized by neighborhood, not just the category of project. We also are in the process of building impact reporting tools that allow a project to, well, allow us as a community to see what the longer-term impact of the funding and of the community support is for projects that are funded through the platform. We also have a two-phase process so that when a project is submitted onto the platform, they actually have to gather enough community support, which right now is indicated via Facebook likes, to allow people in the community to review a project and say, yes, this is something that's absolutely needed. And the intention for that is to help build the crowd before the project needs to be funded. And then finally, the biggest thing that makes Neighborhood Catalyst unique is that it allows people to contribute skills and other resources to a project in addition to cash. So a project owner can say, hey, we're doing a neighborhood art project. We really need $5,000 for material and time, but we also need 3 10-foot ladders and 10 volunteers who are willing to come and clean up the space and help us with this mural. So instead of us only thinking in terms of financial capital, the project is about distinguishing and allowing for other types of community capital to emerge and be leveraged inside of a community. So far, we've had 5 projects on the site since October. The first project was successful in raising more than $8,000 in funds, which was more than 120% of their overall goal. And the software is still in beta. We actually are just now starting another round of development and refinement, especially of some of the custom features that we created. And our intention is for this to be a really thriving platform that allows lots of people to organize projects and collect the resources that they need. The other part of our vision is really taking this initial crowdfunding platform that makes sense to people in terms of I'm a person who's going to contribute directly to this project, and really expand that into other types of community capital. So the next step for us after really building participation, success, and revenue via this platform will be to launch a revolving loan fund where we're able to provide loans of $5,000 to $50,000, which is a really needed space to our members. And to have that revolving loan fund be funded in some non-traditional ways via membership fees from people in the community, via principal-only loans from community members who want to put $1,000 or more into their community. And so these are all things that we're designing and are in process. And I don't have lots of time, but thank you so much for letting us share, and definitely check out Neighborhood Catalyst. This is our project is just for Colorado, but if you love Colorado and love Colorado projects, there's a couple that actually need support and funding now. So I would be remiss to not to not invite you to take a look and contribute if you like. Thanks.
Thanks so much, Mickki. And the good news, I know that this is a lot of information in an hour. The good news is we have many example webinars up online already. So we have a webinar on direct public offerings. We have the Farmer Reserve Fund as a longer webinar that we did last year. We also have Mission Asset Fund as an example in a longer webinar available on our website. And I also really encourage everyone on the call to give BALLE direct feedback on what webinars and resources you want to see going forward so that we can spend more time on the topics that you guys are most excited about. I'm now going to turn it over to Martin to close us out for today. Martin, are you there?
Thanks, Merrian. I'm here. I want to thank all the speakers for sharing their examples today, and Merrian for giving us the great overview. So I just wanted to touch on a couple of other community capital resources that BALLE has. First is that Community Capital Toolkit that Merrian mentioned, and in that, which you all will receive a link to after the webinar and will launch publicly next week, is the 22-page guide to community capital that Merrian referenced, a copy of this webinar and the PowerPoint, access to some of our other community capital recordings, like Merrian mentioned, and then a link to other community capital resources, many of which were mentioned in the webinar today. Also, at the 2014 BALLE conference, which is coming up this June, there will be a Financing Resilient Local Economies track that will focus on community capital. So we really encourage all of you on the call to join us in that conference, because that will be a great conversation with many of the leaders who presented here today. And luckily, today, a registration for our annual conference opens to the public. So we hope all of you will join us June 11th through the 13th in Oakland, California this year. And then if you want to keep the conversation going, we really encourage you to become a part of the Localist learning community by joining BALLE today. For more information, you can visit us at bealocalist.org/join for more information. Again, and I want to give a huge thanks to all of our speakers, to Mickki, Sarita, Daniel, Teri, Dan, and to Merrian for organizing today's webinar. Just a couple closing notes. After today's webinar, Mikel will email everyone registered a link to the call audio, to the presentation materials, and to an advanced copy of the Guide to Community Capital and the Community Capital Toolkit. Please watch for email from Mikel in the next few days. And then right after this call, you'll receive an email with a link to a short survey about this webinar. We'd appreciate if you all spend a few minutes to fill out that survey and give us some feedback on this webinar and the topics you would like to see in future webinars and resources. And with that, I will wrap it up and give you all a huge thanks for joining us today, and another big thanks to all of our speakers for sharing with us. I hope you all have a great Thursday. Thanks, everyone.